morning, good morning. I hope everyone had a great week. I wanted to have a quick message today for my more experienced and wiser audience. See what I did there? So I want to talk about RMDs. And what does RMD stand for? It's a required minimum distribution. And what is it? It is when the government is making you take money out of your retirement account, whether it be an IRA, your 401k, an old 401k plan. And the reason behind this is quite simply they want to tax you on it. We look at how our government spends money, party aside, we have a spending problem. So what's an easy way to get some income back in? Make Americans pull money out of their retirement accounts, which is taxable income. And there's an astronomical amount of money in retirement accounts. As of the end of 2022, there's close to 38 trillion with a T. So that's a lot of money the government knows they can start getting their hands on. So the year in which you turn 73, they are going to look at your account balance on December 31st at the end of the prior year. And that is how your RMD is calculated. So the very first year, you are required to take 3.78% of your retirement account out. Now, you don't have to spend it if you don't need it. I know that wouldn't be a problem in our household, but we have a lot of people who take it out, pay the tax, reinvest it, but the big requirement is just that you take it out. And not doing so is quite a hefty penalty. It used to be a 50% penalty, but now it is still a 25% penalty on top of it still being taxable to you. So that's a very big thing we make sure that all of our clients have addressed when we get towards year end. Now, a couple of notes about this. If you have multiple IRA accounts, let's say you've got 3 different IRA accounts, and each of them has an RMD tied to it. Now, you only have to take the sum total. So let's say between all 3 retirement accounts, you have to take $50,000. The IRS is completely all right if you take all $50,000 from one account. This does not have to be segregated. The only time it does is if you still have money in an old 401k plan or a 401k plan that you are no longer employed with. Then you have to take money out of that particular plan on top of your other IRAs. So there is a factor table. You can figure out how much you have to take every single year based on your age. By age 80, you were taking almost 5%, 4.96 to be exact. And I find it fascinating that if you live to be 120, so yes, they have this in the table, if you're 120, they make you take 50% of your account out and pay tax on it. But that's all I have for today. Hope everyone has a great weekend, and we will talk to you next week. Take care.